Today I will show you my top 5 chart pattern indicators that work like a charm. These indicators can predict the price action with high accuracy, and most importantly, they're really easy to use. I will show you exactly how to utilize these tools for maximum success in trading, so make sure you do not skip any part of this video. Okay, without further ado, let's get into it. So on the 5th place, we've got a tool called double top/double bottom. First of all, let's add a double top chart pattern to the chart. A double top pattern is formed from 2 consecutive rounding tops. The first rounding top forms an upside down U pattern. Rounding tops can often be an indicator for a bearish reversal, as they often occur after an extended bullish rally. If a double top occurs, the second rounded top will usually be slightly below the first rounded top's peak, indicating resistance and exhaustion. Double tops often lead to a bearish reversal in which traders can profit from selling the stock on a downtrend. And this particular indicator is designed to identify the times when the price action makes double tops. As we can see, it predicted the price movement with high accuracy. You basically want to enter a short position as soon as the indicator prints a label that says top 2. Your stop loss can be set slightly above the top 1. And as soon as the price action reaches 1-to-1 risk-reward ratio, move your stop loss to the entry price and then simply set a trailing stop loss of 1 ATR. We see with this particular trade we could have made at least 4 times the risk. Okay, let me give you another example. Here we see the indicator identify the double top pattern. We can see the price action reached our first take profit target. Now we can take a half of our position off. Let's also move our stop loss to the entry price. And now we need to add an indicator called ATR. And check its value. So the ATR value is roughly 0.00050. This means that our trailing stop loss will be set at the distance of 50 pips. Sometimes our profits aren't that big, but they all add up at the end of the day. Okay, now let's add a double bottom indicator to our chart. Double bottom patterns are essentially the opposite of double top patterns. Results from this pattern have opposite inferences. A double bottom is formed following a single rounding bottom pattern, which can also be the first sign of a potential reversal. Rounding bottom patterns will typically occur at the end of an extended bearish trend. A double bottom will typically indicate a bullish reversal, which provides an opportunity for traders to obtain profits from a bullish rally. After a double bottom, common trading strategies include long positions that will profit from a rising securities price. As we can see, this indicator is doing a great job at identifying the double bottom patterns, and if we had entered a long position somewhere at this point, the price could have moved in our favor. Exactly the same money management rules can be applied when using a double bottom patterns. Okay, let me give you another example. So here the indicator identified a double bottom pattern. We enter a long position at the close of our trigger candlestick. Our stop loss will be set slightly below the bottom one. As we can see, the indicator predicted the future trend with high accuracy. Okay, in the 4th place we've got an indicator called head and shoulders/inverse head and shoulders. In technical analysis, a head and shoulders pattern describes a specific chart formation that predicts a bullish to bearish trend reversal. The head and shoulders pattern is believed to be one of the most reliable trend reversal patterns. The head and shoulders pattern forms when a stock's price rises to a peak and subsequently declines back to the base of the prior up move. Then the price rises above the former peak to form the nose and then again declines back to the original base. Finally, the stock price rises again, but to the level of the first initial peak of the formation before declining back down to the base or neckline of chart patterns one more time. And this indicator is perfect for identifying this price pattern. You can enter a short position once the right shoulder has formed. And with this trading strategy, you can target 2 times the risk. Here's another example. So we see the head and shoulders pattern has been formed. You can set your stop loss at the recent swing high. As we can see, 2-to-1 risk-reward ratio does not quite work sometimes. So using a risk-reward of 1 to 1.5 is an optimal choice. The opposite of head and shoulders chart is the inverse head and shoulders, also called a head and shoulders bottom. It is inverted with head and shoulders top used to predict the reversals in downtrends. This pattern is identified when the price action of a security meets the following criteria. The price falls to a trough and then rises. The price falls below the former trough and then rises again. Finally, the price falls again, but not as far as the second trough. Once the final trough is made, the price heads upward towards the resistance found near the top of the previous troughs. You can place a long position as soon as the chart pattern is formed. Your stop loss can be set at the recent swing low. For this strategy, you can be targeting either 1.5 or 2 times the risk. I also noticed that this chart pattern does not happen that often, so in my opinion it'd be better to use all the indicators I mentioned so far in a conjunction. Okay, on the third place we've got an indicator called Harmonic Patterns by Lonesome the Blue. Harmonic patterns construct geometric pattern structures using Fibonacci sequences. These harmonic structures, identified as specific patterns, provide unique opportunities for traders, such as potential price movements and key turning or trend reversal points. This factor adds an edge for traders as harmonic patterns attempt to provide highly trustworthy information on price entries, stops and targets information. If we take a look at this indicator, we can see that it provides different bullish and bearish price patterns. We see some of them have really high accuracy. As soon as a bullish harmonic pattern is formed, you can enter a long position. For sell positions though, the indicator needs to find a bearish pattern. Just take a look at how well this indicator predicted this gap. By the way, traders, if you want to increase the win rate for this strategy even more, you can backtest this strategy on different trading sessions to see which one gives you the best results. For example, you can add sessions on a chart and then go into settings and select only London and New York. So you're only going to be taking trades during these sessions. We see here the indicator gave you a signal to go short, but since we were outside of the trading session, we couldn't have entered this losing short position. Okay, on the second place we've got an indicator called bullish and bearish pennant chart patterns. In technical analysis, a pennant is a type of continuation pattern formed when there is a large movement in a security known as a flagpole, followed by a consolidation period with convergent trend lines, or the pennant, followed by a breakout movement in the same direction as the initial large movement, which represents the second half of the flagpole. Okay, here's an example. We see the price action started moving in a downtrend, then a consolidation stage occurred. The indicator identified the bearish pennant, and once the price action makes a breakout out of this triangle, this signals that the price action will more likely continue to drop. This is a live market, we see the trade is still running in profit. Exactly opposite is true for a bullish pennant. First, the price action must be in a strong uptrend, then a consolidation stage follows. The indicator finds a harmonic pattern, and as soon as the price action makes a bullish breakout, we can safely enter a long position. So yeah, traders, definitely give this strategy a try. Obviously, do not forget to do your proper backtesting before trading live. Okay, we finally got to the indicator number 1, and it's called ABCD Harmonic Patterns. ABCD Harmonic Patterns by this creator right here. This indicator is designed to identify the bullish and bearish ABCD patterns. We can see that its signals are really accurate. Okay, let me give you an example for a long signal. So here the indicator identified the bullish ABCD pattern, and now we need to wait for a bullish candlestick in order to enter a long position. Okay, we see the bullish candlestick is formed. We're going to set a stop loss slightly below the recent swing low, and we're going to be targeting 2 times the risk. Exactly opposite is true for short positions. First, we need to have a bearish ABCD pattern, and as soon as we have a bearish candlestick formed, we can place a short position. To increase your chances of successful entry even more, you can wait for an engulfing bearish or bullish candlestick after a signal. With these rules in place, we can eliminate a lot of losing trades. So yeah, definitely give this indicator a try and see how it goes. Okay traders, I hope you found this video useful. Make sure you click the like button as it really helps with the channel. Also, if you want to see one of my best strategies on the channel I have found so far, make sure you check out this video right here.